Thanks for tuning into Talking Point. I'm your host, Niraj Shah, on a day when the broader markets are showing exceptional strength yet again. The case for a chat with our guest today, and there shouldn't be a surprise considering his views in the past that we're talking about a few of the things that we're talking with him. One is the change of trajectory of rate cuts going to have an impact on deposit growth and on market-wide valuations. I think that's a conversation that we'll have. Is urban consumption, while has looked good, can it pick up further, and will it show in the staple results because it's a week of very important FMCG numbers? And is telecom no longer being a duopoly, leading to a much anticipated uptick in the fortunes of everything related to the sector? I think we'll talk about all of this and more with Ashwini Agarwal of Demeter. He joins us right now on the show. Ashwini, great having you. Thanks for taking the time out. Hope all is well.
Good morning, Niraj. All is well. Thank you.
And Ashwini, great to have you. Can I start off with this, Ashwini? I mean, this is now the 6th or the 7th time in a row that we're seeing the market climb the wall of worry. The reasons may dissipate, the reasons may change, but every single point of time that people have called this market to look very, very wobbly and worrying, right? And for the right reasons, I might add, right? This market seems to come back and climb the wall of worry. Is this, therefore, while expensive a market, remain a buy on dips market?
Niraj, it would appear so. I mean, if you look at the market trajectory from the bottom of COVID, there was only one sort of meaningful correction that you saw. It started sometime in June or September 2021. And then lasted through till March of 23. And even that period, if you break it down, you saw one big decline from September 21 to June 22, and then again from about Jan 23 to March 23. Jan 23 to March 23 was also a fairly mild correction, though, that was the point when the whole Adani stock and Adani group was under a lot of pressure. But barring that, there has been no meaningful correction. And partly the reason is that the macroeconomic outlook for India has never been better. I mean, if I look back at 32, 33 years of my investing career, I think long-term prospects for India have never appeared to be brighter. I mean, you don't have any macroeconomic imbalances. You have a very pro-business policy tilt. And I think, on a global stage, India is set to continue to grow well. So, what's happening is that the domestic investors have kind of understood that this is the long-term trajectory for India and this is how it's going to go. So use every dip to accumulate, and further still, don't just bother about the short term, just keep investing for the long term. And the mutual fund flows are telling you that. So, a value investor like me can keep, despairing that the bond yield to equity yield differences are at all-time lows, and all indicators are telling us that the market is super expensive. But, I really don't see how there is going to be a very deep correction. You could always have a 8 to 10% correction, events for which will unfold as we go along. But I really don't see how it's going to be much deeper in the current framework, unless, of course, elections deliver a surprise or something goes wrong in the rest of the world, then we'll have to see.
Yeah, interesting point, Ashwini, because I remember you also, I mean, yes, you were rightfully pointing out, right, that if you look at on a valuation benchmarks, I mean, it's difficult to make a very convincing large call here. So, Ashwini, what have you made of the results season thus far? Because IT selectively is sulked, but maybe it was in the price, and the start of the financial services reportage, whether the quarterly updates or the actual results, has been okay.
Yeah, I think that's the right word. It's okay. There's no positive surprise. And yes, that can turn out to be a headwind for the market, because if you recall, both the September 23 quarter earnings in aggregate and the December 23 earnings in aggregate surprised the street. They beat the consensus numbers. And the beat was probably not led so much by the large caps, but the mid cap and the small cap cohort did exceptionally well. and aggregate earnings actually did reasonably well. And what we are trying to what we are seeing in the quarter so far, and let me caveat this by saying that we literally have had a handful of results. So we don't know if this is a reflection of things to come. But till now, we haven't had a very strong positive beat so far. I mean, the sole exception is probably Bajaj Auto. And even there, if you look at how the stock behaved post the earnings, clearly the earnings surprise was well baked into the stock price. So yes, I think if the earnings season doesn't kind of lead to massive or doesn't lead to reasonable earnings upgrades, you could have a situation that market could drift down from here. But again, it might be a correction similar to what we saw last year between July and October 23, which was of the order of about 8% or thereabouts. And I don't see anything deeper than that for the time being, unless something bigger comes to pass, which I spoke about, earlier in the conversation.
True. Okay. Ashwini, not asking to talk about a specific stock, but I'm just trying to understand what is the issue with some of the larger banks currently? I mean, for all the conversation around how HDFC Bank is giving value, and everybody from the marqueest of investors to somebody who's a newbie but does good work has given or made this argument about look at HDFC Bank valuations currently versus its own history versus its peer set, and the stock has to do well. Now, you've heard this argument now for 12 to 18 months, right? And at different points of time, the valuation has looked cheap and it's only succumbed to some further selling, except for maybe the last 1 month when it's found some feet. Is the market telling all of us something that it wants to look at large behemoth stocks or financial stocks or other stocks in a different light than what they may have been looked at in the past?
No, Neeraj, I don't think so. I think the bottom line at the end of the day in India is earnings growth, and which is the primary driver of stock price, and the secondary driver of short-term momentum is earnings surprise or earnings upgrades. Now, in the case of HDFC Bank, and due disclosure for your viewers, I do own a position there, being value investor, and obviously it hasn't done well for me last few years. But the point in HDFC Bank is that the merger has led to a situation where it will take them time to fix the liability side of the balance sheet and get to a loan to deposit ratio of about 90%, which is where they need to get to over a period of time. And this interim period, you will see you kind of below industry loan growth or higher than industry deposit growth being forced upon them and resulting to NIM compression. Now, the March quarter was reasonably constructive. It wasn't so bad, but I mean, that's what the street is pricing in. Coming to the rest of the financial sector, I think the question that I'm struggling with is that you will have very decent loans growth, but you will have some compression in margins because deposit costs are on the higher side and liquidity is on the tighter side. Now, the two will compensate each other. And below that, I think on the PPOP side, which is pre-operating profits, banks should be able to meet analyst forecasts. But there is no pickup left below the PPOP line in terms of lower credit costs. I mean, low credit costs are already in the base. So from here on, it's business as usual. And, over a period of time, one should expect that credit costs will normalize to long-term trend. So, you can't build an earnings case of very superlative earnings. Barring some of the PSU banks, which might see some significant write-backs on account of massive provisions and write-downs that they've done over the last 3 or 4 years. For the large private sector cohort, I really can't expect that. And valuations are kind of also, again, ho-hum. They don't leave a lot of room for the upside. So there's no room for earnings surprise. So, what's going to drive these stocks? I'm not very clear.
Okay, the other aspect is telecom. It's right up there in the points of conversation, Ashwini, with the Vodafone FPO getting subscribed the way it has. I mean, the QIB book demand was eye-popping, to say the least.
Yeah.
And some marquee names out there. Now, piece this together for me, a sector which largely has been looking for tariff hikes but haven't come. Jio for the first time, and in the analyst call yesterday, and some analyst notes seem to suggest that the management is now open to looking at some price hikes. So if we are looking at not a duopoly, but three people now being there, Vodafone, I suspect, will not gain market share, but will not lose terribly now, and all of that. And if there is a price hike and all of that, does it bring the sector firmly in focus for the next 12 to 18 to 24 months? And I'm not just talking about the telcos, I'm also talking about an Industar, I'm also talking about some of the ancillaries.
Absolutely. I mean, if price increases come through and the competitive intensity from a price perspective abates, whether it's, three reasonable players or whether it was the case up till now, which was essentially two very strong players and the third player struggling because of limited balance sheet. Uh, Whichever way you think about it. I mean, so long as the pricing power can be exercised by the players, you will see earnings upgrades and you will see the stocks do well. And the entire ecosystem, which is the tower companies and so on and so forth. So obviously, this is very good for the industry. If the price increases come through, we have the cheapest data in the world and we have the lowest cost of mobile connectivity in the world. So, a little bit of price increase is possible. And if that comes to pass, I think, all these stocks will do very well. I think that's really the case. And which I think is why everybody jumped at the opportunity to make this investment in Vodafone Idea, which was priced to bankruptcy at some point in time in the recent past. And now, at the offer price, it still offers substantial upside if the sector economics were to improve in aggregate.
Okay, let me get in my colleague Anushi to talk about some of the results that came out post-market hours on Monday and are making a serious move. Anushi, what do you have on your list?
Hey Niraj, so first on my list is Tejas Networks. Quite a spectacular set of numbers over here. If you have to look at the revenue, that has gone about 4 times up now in this quarter, while the EBITDA and the margins are at 23% margin, which is higher than the Bloomberg estimate of 7%. Now even the net profit has swung back to the profit number at 146 crore compared to a loss of about 11 crore. Now this revenue that we are seeing, about 4 times the growth over here, it is supported by all its product segments, especially led by the wireless segment. Even if you have to look at the domestic play, both the private and the government side performed well, clocking in about 100% of a growth over here, while the international business saw about a 10% growth. Again, if you have to look at the margins, where the major play is, so the margins 23% compared to about 7.5% of an estimate. Now, this is on the back of the company indicating in its Q3 con call also that they had recorded lower set of margins due to the lower capacity that they saw. So that was on the lower end of margins, while this Q4 they were expecting this higher segment margins. So that has led to the improvement in margin mix also. Other than that, the order book stood at about 8,200 crore, with the India recording about 7,900 crore of an order book. Now moving on to next is the Hudson Agro product. Again, a 13% of an up move over here. Strong set of numbers, revenue seeing about a 14% of a growth side. While this is on the back of the normalization that has happened in the milk procurement, which is leading to these better sales realizations also. Apart from that, the EBITDA and the margins is, again, the focus remains over here. EBITDA about 47% of a growth side, but the margins have moved up to 11% compared to about 8% earlier. Two key reasons that I would like to highlight over here. The purchases of stock in trade has gone down by about 49%. So that has supported the kind of growth that we are seeing in this number. And another is the huge differential in the inventory changes also, leading up to this net profit also going about 108% up. So these are the two stocks that are buzzing on the back of strong Q4 earnings.
Okay, Anushi, thanks a lot for that. Well, it seems like that from milk to whiskey, the sales are really happening in the consumer space. Hudson Agro has had a good quarter. Indri whiskey maker Piccadilly Agro had a very strong quarter. In between all of that, of course, Anushi spoke about Tejas Networks and the blowout set of numbers that they've come out with as well. Ashwini, large caps have been slightly quiet, but some of these niche mid-sized players are making their presence felt in a big way. Anything that stood out for you, not just in terms of this quarter numbers, but something that you may have noticed in the last 3 to 6 months?
So think about both the stocks that were highlighted by Anushi, which is Tejas and then Hudson Agro. I think the two themes that are staring out at us is that India is starting to do things at scale. And Tejas's acquisition by the Tata Group has allowed it to exploit the scale that was possible for the business. I mean, India spends a very large amount of money on telecom equipment, the hardware side of mobile telephony and data services. And this was a very, very small company, but with a very strong technology backbone. And I think the ownership by Tata has allowed it to win at scale. And I think what we've seen in the latest quarter is simply a small window into what the future might look like. So that's one theme. And what you're seeing in Hudson Agro is the other theme, which is normalization of margins after the kind of boom and bust cycle that we went through during COVID. Now, while I could go into why milk went through this boom and bust cycle, but I think the point I'm trying to make is that the opportunity resides exactly here. One set of companies are going to be companies that will go from being small, mid-sized players to very large companies. So the opportunity set is extremely large. And there'll be another set of companies in the mid-cap space, small-cap space, which have been hit by very high raw material prices and the margins are compromised, where you will see certain amount of normalization of margins. And I think both these will continue to offer some earning surprises in the time to come. And I think, that's where I'm trying to kind of find ideas. So upstream chemicals, agrochemicals is one industry where I think you will see more of a margin normalization coming through. And of course, the scale business is there in variety of industries such as railways, defense, manufacturing, etc. But where valuations are very, very challenging, so one has to participate with some care. Coming to consumers, I think there are two factors at play. One is that the rural demand has been fairly soft for the last couple of years, driven by soft commodity prices, agricultural output prices, and by limited amount of spending that has gone into rural India. Rural India hasn't fully recovered from the upheaval in urban jobs that happened during COVID. So that's one. And the second is in urban India, you're starting to see a lot of innovation, a lot of direct-to-consumer sales by new startups, which is at the end of the day eating into potential revenue of the big boys. So the large companies in the consumer staples area are not able to produce the kind of growth because some of that growth is getting eaten away by new startups, Mamaearth, or whether it's Nykaa or whoever else it is. So that is playing out. So I think the urban consumer demand is not so bad, but I think there are far more people vying for the consumer's attention.
Interesting. Ashwini, can I request you? I mean, take some time. It doesn't matter. But tell us about how you think about this opportunity sizing when you talk about it. I mean, because whichever example, I'm not saying necessarily Tejas, but whatever else, would love to understand how you think about what the opportunity could be a few years out. How do you think about this?
Well, I think there are various ways to do it. I mean, you try and look for an industry which is very large relative to the size of the player. You try and make an assessment of whether the company has the ability to exploit that size. And the story is not entirely forecastable at the outset, and you have to take a leap of faith and slowly it unfolds. For example, in recent months, we've seen news of BrahMos missiles being exported from India. Over the last 2 years, we've seen significant focus on the success of India's space program. While it has been successful over the last few decades, I think it has come into focus only in the last 2 years or so. So, there are a lot of industries which have a lot of scale possible to them. And innovating at scale has become possible in the last 8 to 10 years, where I think the Indian industry probably lacked the confidence, lacked the bravado, I don't know, and possibly even lacked the policy support previously. If you were to look back at India's history, up till say 2014, 2015. So I think one difference that this administration has definitely made is that through policy support and through the organic growth of the Indian market per se, has made people aware about the opportunity of scale. So it's a very difficult question. How do you size the opportunity? I mean, it is a bit of a leap of faith. It is a bit of just kind of zooming out and thinking about how big the opportunity can be. And then placing your bets accordingly. I mean, you look at batteries, for instance. I mean, Exide, something I don't own, but they signed up an agreement to supply EV batteries to Hyundai. Everybody knew that they are investing in EV. They had a very strong balance sheet after some asset divestments that they had done. They have a very, very strong brand name and a very strong manufacturing backbone. So then the rest is just multiplication and trying to figure out who wins.
Okay. Well, and I'm sure it's not as easy, viewers, by the way, but it's good to get these the thoughts in process. Just one final question, Ashwini, before we wrap up this conversation. The age-old favorites have been IT services for after a really long time. They are going through a period of lull. Some people argue that because this industry is survived and thrived for so many years, you will see a comeback again. Some argue that we are not mutual fund managers. We don't have to have every sector in our portfolio. Why look at IT right now? There are other sectors better out there. We'll revisit IT when the promise is shown, maybe buy it 15% higher, but that's a better way to do it. Which way would you lean on? You are not a mutual fund manager either.
I think the latter, easily. I think the earnings growth is quite lukewarm. And I think if you look at the valuations, despite the correction and severe underperformance on relative basis, valuations are still expensive. I mean, if you look at just the last decadal valuation range of something like Infosys, it has traded at lower multiples in the past. I tend to buy into the argument that if you don't see earnings momentum and earnings growth, is there really a need to be here? Now, I will just make one provision here, that IT services and stocks like HCL Technologies and Infosys have a very decent dividend yield at this point in time. So if the market were to go through a correction, for reasons that are not very clear to us right now, these stocks will probably outperform, supported by the dividend yield, strong cash flow profiles, and obviously best-in-class scores that they generate on corporate governance and so on. So I think they're good companies to protect you on the way down. But if you are really bullish on India and you want to invest for the next 5 years or 10 years, my suspicion is there are better stories to play.
Got it. On that note, Ashwini Agarwal, thanks so much for taking the time out and speaking to us today.
Thank you. Thank you for having me here, Niraj.
Pleasure was ours, and viewers, thanks for tuning into this leg of The Talking Point.